Okay, hello class. This is Demetrius Wilson, Chapter 5. This is Part 3. I lied at the end of Part 2. I realized that the contribution margin, I hadn't gone over that yet, and those were on the following slides. So definitely need to go over that because there's a question on that on your quiz. So we're going to have to do Part 3. But Part 3 should be very, very quick. All right, so we ended with a summary of 4 estimation methods. Different methods will produce different results, of course. Regression analysis is typically the most accurate. Go to Excel. It's a lovely tool to use. Account analysis is effective if a knowledgeable accountant in the company performs the work, right? Remember, it has to be knowledgeable. So prepare a contribution margin income statement, and this is what I wanted to make sure we touched on. So what is wrong with using a traditional income statement for internal reporting? Well, it doesn't split out a variable and fixed costs, for one. Presents cost by functional area without cost behavior patterns. Is used for external financial reporting to comply with U.S. Generally accepted accounting principles, but it's not in conformance with what you need for managerial accounting to make decisions. It does not show fixed and variable costs, which is the main point that we're going to discuss. So what is a contribution margin income statement? And we'll see one shortly. The contribution margin income statement shows which costs are variable and which ones are fixed. So we just want to split it out. So the diagram is going to show you how it normally looks, and it's going to show it a split out. Sales minus variable costs equals the contribution margin. So let's slow down on that part. So sales, how much you sold, the money that you received in revenue for sales, minus variable costs is the contribution margin. The contribution margin is what you contribute to pay for fixed costs and add to your operating profit. Contribution margins minus fixed costs equals operating profit. Statement provides a clear picture of which costs change and which costs stay the same when activity levels change. So there you go. And you see, if you look at it, it's a traditional income statement, which is right here. So if you see panel A, and this is the same thing that's in your textbook, sales is 600,000. Cost of goods sold is $360,796. Nothing that you don't already know and you haven't already learned. So our gross margin is $236,204. Our selling administrative cost is $164,000. So therefore, we know our operating profit is $72,204. But when we look down here at our contribution margin income statement, which is split out just a little bit differently, we see that sales is still 600,000. That's current and static. That number does not change. But variable costs are first subtracted from that sales amount. So you have cost of goods sold and variable cost, which is 320,520. Well, what would be variable cost in the cost of goods sold and the other things that we say? Well, it's going to be the material that was used and not someone's salary, because that's going to fall under fixed costs. Then you have selling administrative costs, which is $4,000. So as you can see, if you go ahead and add those two amounts to 320,520 plus 4,000, you have $374,520 in total variable costs. So you subtract that from your 600,000, and your contribution margin is 225,480, meaning it's sales minus variable costs, and your contribution margin is 225,480, which is the margin on which you can contribute to fixed costs and to your profit or your bottom line. So then in your fixed costs, you have cost of goods sold 43,276. Selling and administrative, you have 110,000. So you see, they're the same categories in variable and fixed costs, but they're split out, right? So you have cost of goods sold and selling and administrative. You have the same thing down here, but they're split between fixed and variable. And then you have total fixed costs is 153,276. You subtract that from your 225,480 because that's your contribution margin, and your operating profit is 72,204. So your operating profit was 72,204 up here. It was also 72,204 down here. Your sales was 600,000 in both places, but the things in the middle, right? The meat in the middle is what we need to understand. We have to have a good understanding on what we pay for fixed costs and what we pay for variable costs when we want to do further examination in regards to our organization. So you want to understand the assumptions used to estimate costs. So what are the two important assumptions that must be considered when using the methods described in this chapter? When costs are estimated for a specific level of activity, the assumption is that the activity level is within the relevant range, right? If they're not within the relevant range, then costs will change. Costs are assumed to behave in a linear manner, right? In a line. Are these assumptions reasonable? The first assumption is reasonable as long as the relevant range is clearly identified. If you don't know what the relevant range is, you are going to have a hard time finding it. The second assumption is reasonable as long as there is linearity. Assumption does not significantly distort the results of the cost estimate, right? So you can't kind of fudge the results in attempting to make it go in a line. So you want to perform the regression analysis using Excel. This is what I mentioned in regards to doing some extra credit. So it says, how can computer software help when performing regression analysis? Regression analysis uses a series of mathematical equations to find the best possible fit of the line to the data points. The software applications such as Excel can use regression analysis to estimate fixed and variable costs. And the goal of regression analysis is to estimate fixed and variable costs, which are described in the equation form of y equals f plus vx. So what are the four steps used in performing regression analysis in Excel? So step one is to confirm that the data analysis package is installed. So if you don't have it in your Excel, then you're not going to be able to do it. Enter the data into the spreadsheet and you make it look just like how it looks in the textbook. Run the regression analysis, analyze the output. The line fit plot and R squared static are used to assess the usefulness of the cost equation in estimating costs. I've done this before in Excel and it definitely works. If you're not a whiz in Excel, then you might not even want to attempt to try this out. But if you go through the chapter, you take your quiz, you read your chapter, you watch the lecture, everything's great, everything's good, and you want to move on and try something new, then try it out. Now, of course, if you don't have a program in your Excel, then you can't do it. But if you do, you can do it for extra credit, but you have to send me the grid with all of the numbers and all the results there, and I will accept that. So as always, have a good day, have a great week, enjoy Chapter 5. As always, we're on the other side of the mountain because it's a 9-week course. We're at Chapter 5. All we have is 6, 7, 8, and 9 left, and then you're out of here. So continue to do a great job as you guys are all doing. Have a good day and a great week.